Hey, what's up YouTube? This is Leo with DRIPCalc.com, and so today we will be looking at Altria Group stock, ticker MO. So this company is paying 8.5% dividend yield, and it is up about 13% year to date. So we will be looking at dividend safety of this company, the earnings, and also compare it to other companies in the tobacco industry, and try to gather whether it's a good investment for dividend investors. So let's begin. So before we dive in, guys, there is less than 10% of you who are watching these videos are subscribers. So I'm asking you to help me build out this channel. It's a new channel. So please smash that like video, subscribe to the channel. Let's bring this number to 15% at least. So help me with that. And also, because we are using our DRIPCalc Pro software to review the stock, we are offering a lifetime 30% discount for all the new subscribers. So I'll leave a discount code in the description below with the link to subscribe, and it's a 2-week free trial. So if you don't like it, you can cancel anytime. Let's begin. So Altria is one of those sin stocks that a lot of investors don't like because they're selling cigarettes, they're in the tobacco industry, and in the past 10 years, the stock returned 96%. That's with dividend reinvested. And just on the stock growth and dividends collected, it's returned 78%. So that's if you didn't reinvest the dividends. So that's not the best performance out there. Even if you got into, say, an SHD dividend ETF, you would get about 180% return. However, this also implies that the stock performance, the stock price, didn't actually do all that well. And if we look at this chart over here, for the last 10 years, it's barely up from $42 up to $45, $46 range. And so recently, like as recent as 1 week ago or so, it was actually hitting 52-week highs. So right over here at almost $47 per share. So why is that happening? I will try to dive into that, and I want to see if this is still a decent buy, even though it has had a massive run up. So one of the things that caused the stock to actually go down after that 52-week high is because there was a ex-dividend date, and so everybody who held shares before this date, June 14th, they are getting a 98-cent dividend for each share. And so this is not reflected here yet because these are dividends that will be paid. And so if we scroll down a little bit, here are the dividends that will be paid. So basically the announcement date, whereas up top, it is actually a payment date chart. So you can see here on June 14th, it was the X date, the dividend was recorded. And so in a few days, so July 10th, you will be getting your dividend. So anyway, let's take a look at dividend safety of this company. So this is very important for any dividend investor, whether you're the company you invest in, whether they will be able to pay the dividends going forward, because 8.5% is a very high dividend yield. Okay, and so you can see here, generally they stay below 95%, below 85% dividend payout ratio. And so that means they're paying less dividend than they are making in net profit, net income. However, there is another measure of dividend safety, and that's dividend to free cash flow. And so that's sitting at 61%. Now, how do we get those figures? We can look over here. Free cash flow per share last quarter was $1.62, and the dividend is 98 cents. And EPS was $1.21, and so that's how we get 81% dividend payout. So let's take a deep look at their EPS and whether this company can actually sustain the dividend payments going forward. So if we look at the EPS over here, you can see that it's going up slightly. Now there's a couple of negative quarters over here, and those are primarily related to Juul investment. So Juul is a company that makes vapes, and Altria had invested a lot of money in that company, and over here in 22 they actually, or even in 22 I think they wrote down that investment. So I don't remember the exact figures, but they essentially wrote it down to zero. And that's very interesting. I'm not sure if they actually still hold that investment. They wrote down the value of the investment. But recently Juul was in the news that the FDA rescinded the marketing ban on Juul's vaping products. So if Altria still holds their investment in Juul, and let's say if Juul becomes popular again, then that could actually positively reflect on Altria stock. Now, I haven't followed that part of the Altria's business for about a year because it was kind of old news, and nobody expected the FDA to rescind their ban on Juul products. So I can't really tell you. So if you want, you should really research. You should read some earnings reports and listen to earnings calls. But at this point they did write down the investment, and I believe it was like around $12 billion. So it was a massive loss for the company, but that's no longer on the books. So right now they still have investment in Budweiser and in some winemakers, as well as in the marijuana business. And Biden basically said that he wants to legalize marijuana, so we'll see how that will affect the stock in Altria. But anyway, so let's take a look at the revenue of this company, and we'll take a look at all years. Now, what over here before like 2006, we shouldn't worry about this revenue, because basically here they spun off. Over here they spun off Philip Morris, and over here I believe they spun off Kraft Heinz Foods, and so that's why the revenue went down. So we should be looking at revenues starting in 2008. Okay, and you can see the revenues are actually going up. Now it's not growing super fast, but they are continuing to grow, and that shows the power in the Altria's power in the tobacco industry, in the tobacco market, because people who smoke Marlboro, which is the #1 selling cigarette brand, probably, yeah, in the world for most likely, but in the US for sure, I think it holds like 76% market share in the United States, the Marlboro brand. And so they have exclusive rights to sell Marlboro cigarettes in the United States. And now Philip Morris International, will take a look at them, comparing that to Altria. They sell Marlboro and other cigarettes internationally, so outside of US. Anyway, you can see the revenue is going up. So, however, there's a different trend that I have noticed, and that's in the last 4 years, the sequential revenue actually is not so good. So take a look at this. Their Q1 of each year is usually the lowest quarter for the year. So if we look at Q1 24, it was 4.72 billion. So rewind back to previous year Q1, 4.76 billion. So that's $40 million difference going down. That's not good. Let's go back another year, another $60 million going down. Let's go back again, and that's another $60 million. So the Q1, so over here in 2019, it was still growing, but over here after 2021, it actually, no, this is the Q1. So yeah, 2021 Q1, 4.88, and then 2020, 5.05 billion. So it's been going down ever since the Q1 earnings. Now, that's not indicator for company as a whole, because you can see over here in Q3, they actually made a really nice 6.28 billion revenue. That was the highest on record. Excluding, of course, Kraft Foods and Philip Morris International. So after those spun-offs, it was the highest revenue. I'm not really sure what this was over here. That's basically in the middle of the Great Recession, so I'm not sure why they had higher sales. But overall, the trajectory is going up. You can see on the CAGR, and as far as revenue goes, and it's very slow growth, 1.64% per year over the last 10 years. And however, in the last 1 year and the last 2 years, the CAGR is negative. So that's what I am not really liking for Altria. And the reason for that is fewer and fewer people are smoking, and a lot of my friends are quitting smoking. So that's anecdotal evidence, but nevertheless, people are not smoking as much as they used to. However, if we look at their net income, which is a much more important metric, you can see the 10-year CAGR for our annual growth, average annual growth in net income is 6.15%. 1 year, you can't really use this number, because this is when they took the loss on the Juul investment. So I think looking at 5-year and 10-year makes much more sense. And somehow this is included in there. But if you compare this number to a number from 10 years ago, so 2014, it is a massive increase. So overall, the net income is going up, and the way they're achieving that is by raising the cigarette prices. And people who smoke, it's an addiction, they will most likely continue to smoke. However, there is fewer and fewer younger people that begin smoking, so their market share is dwindling, and addressable market is dwindling. So that's not a good thing. Okay, cash and debt. Let's take a look at that. Their cash is kind of hovering around $3 billion mark, and here it was a little bit higher, but also higher debt. And the debt grew a little bit, but not significantly. So overall, they're kind of managing the debt nicely. And also, the very good sign for this company is they're buying back their shares. They're buying back about 1.5% per year as of recent. And over the last 10 years, the average buyback rate was 1.24%. So that's nice. They're reducing the share count. That means they have to pay less dividends. And but on the other hand, that also artificially changes or manipulates earnings per share because you have fewer shares. So now fewer shares basically are included in that EPS, so that kind of changes the EPS a little bit. Now, profit margins, they have very high profit margin. Gross profit almost 70%, and the net profit margin, so this is what I like, it's actually going up. We should ignore these quarters right here because this was the Juul investment fiasco for them, and but overall you can see the line, and it's going up. Over here it was around 27.5%, and now it's 45% net profit margin. So the company is very profitable, so they retain a lot of the cash they actually earn. So price to sales, let's look at price to sales, and price to sales is actually going down, also a good sign. That means the shares are becoming less expensive in terms of revenue per share. PE also going down. That indicates that the share price is going down relative to the revenue, price to earnings. So the price per share relative to earnings is going down. That's a good sign. That makes the investment more favorable. Okay, one important metric is capex. Their capex is very small. I mean, they have like $6 billion per quarter revenue, and capex is around 50 million or 40 million mark. So that's the average. Let's call it like 50 million average. So that's a very small capital expenditures. Stock-based compensation is also almost non-existent, 58 million once a year. Let's call it 40 million once a year. They're basically giving stock compensation to the CEO and other C executives. But overall, it's very tiny compared to their revenue and net income. So net income, you can see $2.13 billion per quarter. That's a pretty good net income. So they have a lot of money left for the dividends and for share buybacks, and also to grow the business. Now, here are my thoughts on the dividend safety. So current dividend is 98 cents. However, they have a history of raising dividends every 4 quarters, so once a year. And their dividend increase over the last 10 years, so the CAGR is 7.4%. However, in recent years, they really slowed down. So now it's about 4.25%. That's what they raised over here, from 94 to 98 cents. And they're expected to raise dividend again. However, and let's take a look at their EPS. I don't think they will be raising it by 4 cents this time around. Last year, I was almost convinced they would raise it by 4 cents, which they did. But now let's take a look at their EPS. So $1.16, $1.21, $1.22. Over here was just $1. This quarter was negative. I believe this is when they took that write down on the Juul investment. But their EPS is barely above their dividend amount. And so at some point, if they continue raising the dividend by 4% each year, and we know that the smoking market, the tobacco market is contracting, fewer and fewer people smoke, at some point the EPS will not be able to cover the rising dividend. So I would say that this year they'll raise the dividend by 2 cents, maybe 3, so it would be $1 or $1.01. I don't expect it to be $1.02 because that would add a lot of additional expenses. Even though they're reducing the share count, I don't think the dividend increase is enough to be offset by the share buybacks. So I think the dividend increase will be 2 or 3 cents, and that will lower the CAGR to about 3% or maybe even 2%. And so while it's a very high yield stock, I don't think there will be much of growth as far as dividends, because the company doesn't have a lot of room to grow their revenues. Now, sure, the wine business is that's not really going to grow. The beer investment in the Anheuser-Busch also hasn't paid out so far, especially with the fiasco of Bud Light recently. So the only real avenue where they could see a substantial increase in the revenue is from federal government basically legalizing marijuana, and I'm not sure that's going to happen anytime soon. I think if Trump becomes a president, that's not going to happen. Biden promised it, but I think it was a just election stunt just to get the votes, and because he had 4 years to do it and he hasn't done it so far, and he didn't even try. So I don't think that's happening anytime soon. Now, I am not big into that, so I'm not sure if they'll legalize it or not. It doesn't really matter. The company doesn't have a lot of room to grow. You can see the revenue in the last 10 years only grew by 1.64% per year. Therefore, basically buying this company is you're buying income. Potentially you will have a little bit of stock appreciation. However, going back to the stock price, So over here, let's take a look at 1 year. Not even looking at October of last year, many stocks were down in October. Okay, so you can see it took a massive dive over here. But like as recent as 3 months ago, the company was at below $40, and as recent as a couple of weeks ago, it was almost $47 per share. So it had a massive run up, almost 20% run up in the share price. So is it justified? I think it's a little bit overpriced right now. So what I actually did, I actually sold some shares. I even I had covered calls on my position, and I basically bought them back at a loss, but I sold the shares at a profit. So overall, I sold at about $45.50, considering the loss on the covered calls. Okay, but I thought that it's a good time to sell the stock rather than a good time to buy. So I don't think the current price for the stock is justified. I think it's going up together with the market because the S&P 500 is beating records like every other day, and if it doesn't beat the record, then people go cry in the corner because oh my god, it's the end of the world and the stock market is crashing if they don't make another all-time high at the end of the week. So I think the Altria stock went up in solidarity with S&P 500. I don't think there is underlying reasons for the stock to have a 17-18% run within 3 months. I just don't see that. And so will I be buying this stock? If it drops to like a $40 range, 41-ish, then I probably will reopen that position that I closed. However, at current price, I think it's a little bit overpriced, especially given that the stagnation in the business, stagnation in the income. You can see EPS growth is EPS growth is actually pretty nice over the last 10 years at 7.5%. So that's not bad. That's not bad. So they're becoming more efficient. Yeah, and we can see that actually from net profit margin. So they're becoming more efficient. I think they laid off some employees, so they cut the expenses, and that's a good thing. So, but still, the EPS is not much higher than the dividend, and they're about to raise the dividend. So I won't give them a multiple they're getting right now. I would wait until like $41 range to start reaccumulating the stock. All right. So now let's compare this to Philip Morris, because Philip Morris is the company they spun off in 2008, and so we can look over here. This preloaded 10 years, but you can see over here the Philip Morris share price from the beginning of time, and the beginning of time was April of 2008, and basically on the share price it's doing great. And also if we look at Altria in the same time period from 2008, where is it? It's also done great. So it doubled in share price from $22 to 40, almost 46 today. And the Philip Morris in the same time went up from $50 to about $100 right now. Yeah, $100. So it also doubled in price. However, the total, in terms of total return, Altria actually returned a little bit more. So we can see here 96% for Altria versus 82% total return. That's with dividends reinvested. And so 82% for Philip Morris. And you can see the total return curve right over here. Actually, here we have a price chart, but they were priced differently, and this doesn't go back to the beginning. Let's change the time period to say 20 years. Now it will actually limit by the shortest period, and that would be by Philip Morris's lifetime. So the interesting part here is it includes the share price of Altria at the time of spin-off, and you can see it dropped significantly because of the spin-off. So that's not really a proper representation. So, and let's take a look at not 16.3 years but 16 years. Okay, so that's close enough to the beginning of Philip Morris or PM stock. Okay, so here they're equal, and you can see the total return since then for Altria stock is 466% versus 331% return for Philip Morris International PM stock. At some point, Altria was doing much better. Like over here, almost 500% return versus 254. So anyway, that's when Altria stock was really expensive in 2017. So that's that's the past. But as far as dividends, you can see the dividend curve, the dividend yield for Altria is going up, and it's in April it was sitting at 9%. Now the stock has gone up in price since then. And Philip Morris is growing. The yield is growing a little bit slower then Altria, sitting at a respectable 5.5%. But I think if you're choosing between these two companies, the PE ratio of Philip Morris is just much higher for some reason than that of Altria Group. So 16.5 PE for PM versus less than 9 for Altria. That's it clearly shows that Philip Morris is a more overpriced stock in terms of revenue. And as far as revenue, let's take a look. So in the last 10 years, revenue is pretty flat for Philip Morris also. So we can see the CAGR. So it grew by 2.39%, which is higher than that of Philip Morris, of Altria, but still it's such a slow growth that you essentially buying yourself an income. There might be a price movement a little bit, and that would be nice, but you can't expect a lot. Okay, and as far as revenue, net income, so you can see 2.13 billion revenue in one quarter for Altria, and pretty much the same for the Philip Morris. So yeah, and EPS is the more interesting part here. Let's take a look at the EPS, earnings per share. Now again, keep in mind the shares of Altria are less than half the price of Philip Morris, so $1.21 versus $1.38. So you get a lot less revenue per share for buying Philip Morris than Altria stock, and that's why I actually like Altria stock better. That's why I was invested in it instead of Philip Morris. It's just a higher revenue per share, higher dividend per share, and much lower EPS, or much lower P, or price per earnings. Okay guys, so that was my look at Altria stock. Again, it's a great dividend payer. It is paying 8.5%, 8.58% right now. That's a forward yield, and again, they will probably increase the dividend. That will be like in a month and a half from now when they announce earnings. So on July 31st of this year, they'll be announcing earnings, and just around that time, maybe not the same day, maybe a few days later, like a week or 2 weeks later, they'll announce dividends for Q3, and they're expected to increase. My expectation, they will increase it to $1 even. Now they could increase it to $1.02, and that would be a nice increase, about 4.1% increase. They could, but then they're once they announce that dividend, they cannot go back on it because they have a history of increasing dividends for many years. They're a dividend king. Now again, this here looks like a drop in dividends, but again, they spun off Kraft Foods and they spun off Philip Morris International. So overall, they've been growing their dividends for, as far as our data goes, 1970. That was 54 years ago. They've consistently grown dividends, and so if they cut the dividend, people will just like sell out of the company. That means the company is done. If company is cutting dividends, something is wrong. Okay, so I think it's safer for the management to raise the dividend by 2 cents or 3 cents. This way they have more run room going forward to keep increasing the dividends going forward. Okay, and so based on those assumptions, let's take a look at let's calculate potential returns if you invest in in Altria stock. Okay, let's say you invest $10,000. We'll put this monthly investment at 0, and this is today's price. Okay, so dividend growth, I think we can keep it at like 2.5%. Share price, I think it's overpriced right now. Therefore, I think keeping minus basically 1%, minus 1% share price, basically decrease. Okay, and let's calculate that. And if you invest $10,000 today, then in 10 years you would end up with $24,721. And then if we change this to 20 years, you would be sitting on a sweet $90,000, almost $91,000 portfolio. Now, again, because this is a tobacco company and fewer people are smoking, I think looking at this stock for 20 years is probably more on the risky side. Will they be around in 20 years? Most likely. Are they going to be the same size as they are today? Probably not. I wouldn't say so, because in 20 years a lot fewer people will be smoking than they are today, and they can raise the price of the Marlboro cigarettes only so much until like people can't afford to buy those. So they might still smoke, but they'll smoke less, and a lot of people will just trade down to a cheaper brand, because in the area where I live, the pack of Marlboro costs about $14, and you can buy some no-name cigarettes for about $8. Even some of them go for $7.69. So a lot of people, if Marlboro becomes like $18 a pack, they'll just trade down. They'll buy a pack for $9, some no-name company. A lot of them will. Now, some will forever stick to Marlboro brand. I know a lot of people who smoke Marlboro, and they're just like, they don't want anything else. But you know, $18 a pack is an insane price, and people will just start cutting down. Therefore, I think in 20 years, I don't think the company might be around. Well, I mean, it will be around, but I don't think it will be the size that it is today. So I don't see the growth for this company going that far out. So I would stick with the 10-year projection. I think it's much safer. And if we look at this chart over here, if the stock price decreases by 1% per year, then in 10 years it will be around $42. Now you can play with these numbers. Let's say the stock price goes down by 2% and the dividend increase stays the same. You can expect to have $23,000 portfolio value. However, your dividend, total collected dividends, will be $16,450. You can see it over here in the chart right here. This is the total dividends. Now, if you add, let's say, if you add like $200 per month to this, if you increase your investment, then in 10 years you will be sitting on $63,000. So if you continue to invest $200 per month, and you can see your total investment by then would be $34,000, and so your total return will be around 30 grand. Okay, and your total collected dividends will be higher than your total investment. And after that, the company would still be around. They would still pay dividends. So it's not like you have to sell. That's the end of the road. But like, we don't know what's going to happen in 10 years. I just don't see many more people getting into smoking. So, all right, guys. So if you enjoyed this video, please click the subscribe button. Help us grow the channel. Your likes really help the algorithm, the YouTube algorithm, show these videos to more people. And when you subscribe, YouTube sees that people like the content, and they show it to more people. So I would really appreciate it. Now, if you want to try out this software, again, we're offering a 30% lifetime discount to anyone who signs up. That's a limited time deal. We're doing away with it in a couple months, but for now it's a 30% lifetime. Even if we change the price in the future, you're still getting the same price. So lock in for life, basically. And we have a 2 weeks free trial, so if you don't like it, you can cancel and nothing will happen. You won't be charged. Just enjoy the software for free for 2 weeks. Okay, guys, thanks for watching. I'll see you in the next video.